Hello everyone, a very good afternoon to all of you. My name is Shweta Jain and I head the residential practice for Savills India. I'm pleased to welcome you all to the first session of our UK webinar series focused on the London property market. Joining me here are my colleagues from Savills UK and India. Taking a quick moment to introduce Savills and our operations around the globe and in India. Savills PLC is a global real estate service provider listed on the London Stock Exchange with an international network of more than 600 offices and 39,000 associates offering a broad range of specialist advisory, management, and transactional services to clients all over the world. Savills India, a group company of Savills PLC, started in India in 2016 and has full services offices in Bangalore, Mumbai, Delhi NCR, Chennai, Pune, and Hyderabad. We serve occupiers, investors, and developers across office leasing, project management, capital markets, valuations, research, consulting, industrial and logistics, and residential services. Under residential, we offer international residential services to assist Indians acquire homes across the globe by offering help on property transaction and management. Today, we aim to answer some key questions around the current real estate landscape in London, overview of prime resi markets, price trends, the right time to buy, RBI guidelines on purchase for residential Indians, and many other interesting facts around the London residential market. Home to over 9 million people, London attracts people from all over the globe, and it remains a sought-after destination for Indians as well. Indisputably, the capital of the world, it carries a prominent global standing in terms of business, trade, amenities, quality of life, stable legal and political system, and is one of the most high-profile locations for property investments across the globe. A few other reasons that would make it an attractive place to live and work for Indians would include its time zone, use of the English language, historical and global ties, world-class educational system, and access to financial markets. I will now request my colleague, Ed Lewis, to introduce our esteemed panelists and begin the session. Thank you.
Good morning from London. Good afternoon to you in India. Thank you very much for sparing some time for us to introduce the UK and London property market. I'm delighted that my colleague who runs the London research team here at Savills will be presenting, and followed by Jen, a colleague in our international department, who will be just spinning through one or two schemes as opportunities you might like to consider. And as Shweta said, we're going to have a panel session which will include myself and her sort of hosting the questions and butting in, but actually looking for Dhruva and Gabby and Jen to just explore some of their expertise around some of the questions that you have already submitted. And of course, any further questions you would like after the seminar, please don't hesitate to send us an email in due course and we'll come back to you. Without further ado, pass you over to Gabby, please.
Thanks, Ed. So today I'm going to be talking about what's happening in the UK housing market and specifically what is happening in central London. So if we just start by considering what the UK housing market looks like in terms of value. So looking at this map, you can see the highest value areas are in the darkest red, with lower value ones in lighter yellow, with the average price across England and Wales standing at £340,000. Now that ranges from just 125,000 in lower value markets like Wales to over 800,000 in the wealthier markets such as London and the southeast of England. Now, just zooming in a little bit closer on London, the average value of housing across London is almost double the average of the rest of the country at £670,000. You can see the most expensive markets are concentrated in central London, but we also see wealth corridors extending north towards markets like Camden and St John's Wood, as well as southwest through the likes of Battersea and Richmond. So in terms of what has been driving the UK housing market over the last year, it has of course been anything but normal because of COVID-19. So for the first time, we've seen the housing market and the economy dislocate. Usually when the economy goes into recession, house prices fall, and that's exactly what we saw in the financial crisis. But the opposite has happened this time round. Now, there are a number of reasons for this. Firstly, we've come into this crisis in a period of very low house price growth. So not like in the run-up to the financial crisis where prices were increasing rapidly. We're in a period of very low, historically low interest rates. And there was generally a feeling that the economy would bounce back from this relatively quickly. We've also seen government intervention in the form of furlough, which was designed to save jobs. And of course, the stamp duty holiday, similar to the one that was in Mumbai last year, has provided people with an incentive to move. But more generally, we've seen that the market is being driven by those who have greater financial security, so people upsizing rather than first-time buyers. And the experience of lockdown has made people really reassess what they want from their home, with many looking for larger homes with more space inside as well as outside. And this behaviour has really overridden economics. So as a result, we've seen very strong house price growth of around 10% across the UK and very strong transaction levels. In June, in the run-up to the full stamp duty holiday ending, where you could save a maximum of £15,000, we saw double the number of transactions compared to before the pandemic. But now that full holiday has finished, it does continue in a tapered form until the end of September, where the maximum saving is £2,500. But we are seeing that the market has cooled somewhat, with August seeing the first month-on-month price falls. Now, this change in behaviour over the last year has had different impacts on different parts of the market. So if we look at the prime London market in particular, and by prime, I generally mean the top 10% of the market by property value. So the largest house price growth over the last year has been across the southwest and the west of prime London. These markets tend to have more green space and larger family homes, and so they've really benefited from those people looking to upsize. Whereas the north and east, which covers areas like Canary Wharf and Shoreditch, tend to be higher density, and as people have been working from home and amenities have been closed, these markets have struggled more. These areas also tend to see more international buyers who, of course, have been held back by travel restrictions. Now, this is the same for prime central London, but actually that has seen a bit of growth in the last year. Now, to put into context why that growth in central London is so significant, this chart is looking at annual growth since 2013, and you can see that prices have been falling in central London for a number of years. Now, this is due to various tax changes shown here, as well as ongoing uncertainty following the EU referendum in 2016. But with the decisive general election in late 2019, which put Boris Johnson into power and gave a much clearer outcome for Brexit, it did seem like the market was on the cusp of recovery. Now, this has been somewhat disrupted by COVID, but the growth seen over the last year does suggest that the market may now have finally bottomed out. So there was growth of 0.5% in the year to June, but significantly, prices are still over 20% lower than their peak back in 2014. And we are starting to see this recovery in transactions in central London too. So in the second quarter of this year, we saw the strongest number of transactions in the market above £5 million for any quarter since 2014. And that's despite a lack of international buyer in the market, suggesting that when they do return, we could see a real spike in sales. And actually, despite the changes that we have seen to tax over the last few years, including the 2% stamp duty surcharge that was introduced in April of this year for international buyers, London does remain a competitive city to invest in when other costs are considered. So if you are buying a $2 million property as an overseas investor, taking into consideration the relative costs of buying, holding that property for 5 years and then selling, it's less expensive to invest in London than other major cities like Hong Kong, Singapore, Mumbai, and New York. And actually, even when that stamp duty holiday ends, London only moves up one place above Paris. And another consideration is the currency advantage that many buyers have. Sterling has been weak since the EU referendum in 2016, which has incentivized many international buyers, especially if you consider the price falls that we've also seen in the market over the last few years. But sterling is forecast to strengthen over the next few years, especially against the rupee, meaning that that window of opportunity to make use of that currency advantage will start to close. But more generally, despite Brexit and COVID, there are a number of reasons why people continue to invest in London. So the fears of significant job losses in the wake of Brexit haven't materialised. Doubts of London's ability to attract the biggest names to its office markets have been somewhat unfounded, with Google signing for a new £1 billion office in King's Cross, and major tech firms such as Netflix and TikTok have also signed leases for new headquarters in London within the last year. This is also being seen in cross-border investment, with $13.6 billion invested in London in the last year. That was 44% higher than the next highest in Paris. And the trade deals being agreed will continue to drive this investment post-Brexit. The UK has also been one of the leading nations in the rollout of the vaccine and has relaxed social distancing measures. This really provides optimism with the return of central London's famous city buzz, and it won't be long until we see the full return of tourism that is so important to London. We think the new normal will also mean that people place a greater emphasis on well-being and particularly green space. And 47% of London is green, with over 3,000 parks. Now, in comparison, it's estimated that only 27% of New York is green space and less than 10% of Paris. And finally, London has held the reputation of being a safe haven for property investment for many years. Brexit and the pandemic, whilst providing short-term hurdles to overcome, have done nothing to change London's standing as a safe long-term investment. As Shweta was saying, the culture, the heritage, that secure financial and political institution we have, the language, and even the time zone still remain fundamental reasons why people look to invest in London. And a really key driver for buyers is the educational offering. So there are 4 universities in London that are ranked in the top 50 in the QS World University Rankings, and no other city in the world can boast more than that. Not only does this act as a significant draw for overseas students to study here, but it also provides a world-class pool of talent for graduates for London businesses that again can't be matched in other cities. And interestingly, international students haven't been put off by the disruption caused by the pandemic. We've seen that the number of international UCAS applicants from outside the EU actually reached record levels in 2021, with 85,000 applicants, and that increased 17% on 2020. So finally, what do we think will be the key drivers in the market going forward? Well, the prime London and particularly prime central London market is more driven by wealth than mortgage debt. So it's not particularly at risk to any uncertainty in the lending market. And it's also generally less exposed to a slowdown following the stamp duty holiday, as it presents less of a saving at the top end of the market than the lower end when you consider the overall cost. But the prime London market is more exposed to any tax changes or political uncertainty, and we have seen the impact of that since 2014. It can impact buyer sentiment, and we have to consider that the government will be looking to make back some of its losses from the amount that they have spent on the COVID pandemic. But with prices in central London still 20% below that 2014 peak, the market does look good value, particularly if you're also buying in another currency. And there does appear to be a significant amount of pent-up demand from international buyers who haven't been able to travel. And that very fast rollout of the vaccine and loosening restrictions will serve to boost confidence further, So we think that demand is likely to be strong through the rest of this year and into next year. But behaviours and lifestyle factors will remain important drivers. So in terms of what that looks like in numbers, we think that prime central London is currently at a turning point and will continue to strengthen through the second half of this year. But it is likely to really see the recovery take hold next year when hopefully COVID is behind us and international buyers can fully re-enter the market as the economy also recovers. We could see a bit of a dip in growth in 2024 if we see another general election, as we know that can bring some uncertainty. But beyond that, we do expect to return to trend level growth of around 4% a year, which would give a really strong total growth of over 20% growth in central London in the next 5 years. So that's all from me. I will now hand over to Jen, who will run through a few developments currently available in London.
So thanks, Gabby. We have over 90 developments which we currently sell in the UK. So today I'm just going to take you through 5 of these very briefly, all of which are, minutes away from public transport and are incredibly well connected into central London, which of course is always a key selling point for buying in London. So I'm going to take you through Embassy Gardens first, which is located in 9 Elms, one of the biggest transformations in London, being in very much the heart of 9 Elms and the home to the new US Embassy. Its close proximity to Vauxhall and Battersea Park and London Victoria make it incredibly, attractive to both local and international buyers. Designed by award-winning architects, taking inspiration from Manhattan's meatpacking district and featuring London's very first sky pool spanning between 2 buildings. You can see it there in the bottom right image. It's absolutely incredible, and some of the residents are absolutely loving making the most of it as it is at the moment. So the final completions for the modern building will be September through to March next year. So completely ready to occupy. All residents' amenities are now completed and operational. Therefore, you get a completed product, including the sky pool. It's incredibly well priced compared to the local new build competition. For example, the Dumont just nearby is at £1,919 per square foot. Nearby, obviously, Battersea Power Station at £1,600. And I think it's very opportune for us to point out here, this has been one of the best selling developments in London over the last 12 months. It attracts, people from all over the world. All of our agents have been very excited to see this nearing completion. So just nearby, also in the southwest, is Kings Road Park. It's situated in Zone 2 in southwest London, just 60 metres from the Kings Road, which you really don't get more Chelsea than that. You may be also familiar with the Chelsea Football Club, which is located moments away, as well as the River Thames. Kings Road Park is set within 6 acres of beautiful landscaping and is one of Berkeley Homes' largest developments. I mean, you can see from the images there, it really showcases such a beautiful product. There's 24-hour concierge, pool, swimming pool, sauna. Much like Embassy Gardens as well, the Ballymore also produce incredible facilities. And here Berkeley has really spent so much time looking at what buyers want, what tenants are looking for when they're looking to let out an apartment. It's in an established and desirable residential location. And as you can see, the architecture of heritage buildings is absolutely beautiful. It's a large regeneration in the heart of southwest London, which often is hard to find. So without a doubt, this has been one of the best-selling developments for Berkeley Group. I think it really goes down to it's well-priced and it's outstanding residential facilities. Moving over to the other side of London, we have 1 Bishopsgate Plaza. The Sky residences at 1 Bishopsgate Plaza offer a really rare opportunity to live in the historic heart of London's famous Square Mile, with hotel service residence and amenities available. The highly secure and private apartments are a collection of 1, 2, and 3 bedroom apartments. Uniquely, they start at actually level 21 and extend upwards to ensure every home benefits from panoramic views of the city and beyond. So in addition to the residents' private amenities at One Bishopsgate, it also houses Europe's first Pan-Pacific hotel, which actually opened yesterday. This offers residents exclusive access to the 5-star amenities. So if you're looking for a best-in-class hotel facility with exceptional views, you definitely should look no further. There's the residents' concierge and sky lounge, access to all different floors. And as I mentioned before, the fact that it starts from level 21 gives you exceptional views throughout London and surrounded by some of the most amazing restaurants that London has to offer. So as you can see, this is an exceptional building designed by unbelievable architects. And it's really a kind of one-stop shop if you're wanting to be located in central London, in the city, incredible views. You know, you can have room service up to your room. You can have your clothes pressed. So if this is somewhere that you want to have in London as a place to stay or for your children to live in, it's definitely worth taking the time to speak to Dhruva and the team about looking at One Bishopsgate Plaza. Moving on to a really historic development that is actually a very special one for Savills to be selling is Regent's Crescent. It's arguably one of the best locations in central London. Sorry, arguably one of the best addresses, let's say as well. Originally built in 1820 for the Prince Regent and designed by architects John Nash. It's grade 1 listed new build and exceptional ceiling heights, up to 4.25 meters. There's 1.5 acres of private gardens and there's 8 acres of communal gardens with tennis courts, exceptional park and garden views, secure underground valet parking, concierge. Like all of the other developments that I've just spoken about, there's 9,000 square foot of amenity space. And I think it really showcases that beautiful historic architecture of London. Now, taking you out to, a little bit further out from London is a development called Horlicks. Horlicks is a large regeneration scheme in Slough. Some of you may have heard of Slough. It's 22 miles west of central London and 3 miles of the historic Windsor. You'd be very familiar with Windsor Castle. Therefore, it neighbours so many of UK's most affluent addresses outside of central London. You might also be familiar with the brand Horlicks for their production of molten tea. And this site, in fact, was the original Horlicks factory. And therefore, we've already seen really strong interest from UK buyers who would like to purchase in the restoration of the original, Horlicks building itself. We commenced selling this first phase last year and we're already 95% sold now. So there's enormous uptake, both from the local market, but especially international buyers that can see the capital growth on this with really strong yields. We're now selling the second phase and 50% sold. This block has 33 private units with 1 and 2 beds, all with balconies. Whilst I've spoken to you about, quite a few of central London developments, I think it's really important for you all to know how many developments Savills actually does sell beyond central London. And our team are very happy to show you through our whole showcase. But this, for example, Slough is a main centre on the M4 Western Corridor, which is known as the UK Silicon Valley, due to the high number of technology companies and is hyper connected on that commuter belt. So you can really arrive into, 8 of our major universities within an hour, making Slough really attractive to young professionals, especially given prices start from about £297,500. And it goes without saying, the Slough Council have invested $3.5 billion of regeneration in towards the town, improving transport, employment opportunities. And I guess this really is the key selling point for Barclay's scheme, Horlicks, because it's located just 500 metres from Slough's station, which is, housing one of the Crossrail stops. I mean, today I've really shown you just a really quick whistle-stop tour through some of the developments that we just thought could be really interesting to you in the market there in India. So I hope that gave you a snapshot of some of the developments that we're currently selling. As I mentioned, please do get in touch with Dhruva and our Savills India team. We will send you a copy of our property portfolio, which showcases developments anywhere from £200,000 through to 60 million. So there very much is something for everybody's budget. whether it's investment, owner occupier, we're very much here to help. Now, I know some of you have sent through questions, so I'll pass it over to the panel and we'll hopefully answer some of them for you.
Thank you, Jen. It was most enlightening to hear about some of the developments that Savills is marketing. And I would just like to now go to Dhruv and ask a few questions around whether Indians are permitted to purchase property in overseas or not. Dhruv leads our international residential desk, and he's been interacting with clients over the last 2 years, and there are learnings during our journey. And Dhruv, just talk to me a little bit about what are the regulations around Indians being able to buy properties overseas?
The short answer is yes, it's absolutely legal and it's permissible for resident Indians to purchase overseas property. In fact, the purchase of foreign property by resident Indians is regulated by FEMA Act, by RBI. So Indian residents can purchase overseas property through a number of different routes. Each of one has a different legal and tax connotation to it. A resident Indian, including minors, can remit up to $250,000 per fiscal year, and they can even club the money to buy assets together. And if that's the way they're remitting and buying assets, then the property has to be registered in all those people who remit money. Now, another option is available to Indians is they can purchase overseas property through the ODI route. In the ODI route, the RBI regulations permit Indians, to buy through LLPs and partnerships. This is basically for the business and the staff residences. And there's a condition that it can be only up to a certain percentage of the turnover, which is permitted. So, there are ways Indians can buy, and every sense in which they buy, that is regulated by different conditions. So I hope I've answered that query well.
Yeah, thank you so much. Also, just talk to us a little bit about the finance options, because that's a question which comes our way, most often, where Indians look at, and I'm referring to resident Indians right now, not non-resident Indians, but they seek home loan or mortgage options. So is that possible for resident Indians?
It is possible. There are ways in which it can be structured, the purchase can be structured. Now, I'll just give an example in which a resident Indian is buying an immovable property overseas, in which the funds have been remitted primarily through the LRS route. In the LRS route, which I spoke about, $250,000 per individual per fiscal is allowed. You cannot take out a mortgage, and that's plain and simple. You cannot. It's regulated in that fashion that you cannot. However, if you are buying through the ODI route, in which there are conditions of number one being your subsidiary company, which is overseas, is buying for the staff residents or for the business, it has to be used for that sole purpose on books. And number two is it has to be a bona fide business operation. It can't be a shell company holding these residential assets for that individual. So yes, it's possible taking advantage of low interest rate overseas, but it has to be structured in that sense in a proper way.
Okay, great. So what I hear you say is that under the LRS scheme, a mortgage may not be possible. However, should the acquisition be routed through an ODI route, then there are possibilities to work around the financing options, right?
Yes.
Thank you so much, Sue.
I've got a question here, which probably we will host in London, and to Gabby, if I may. But broadly speaking, it's around the opportunity to buy, and the question comes: since London trades at a lower level than in 2014-15, do you believe this is an opportunity time to look and invest in London? And if you were to invest, which micro market might you pick up from a capital appreciation point of view?
Yeah, sure. So, I mean, it's always difficult to know exactly when the right time is to buy, but I think from a pricing point of view, we do appear to be at a turning point in central London where a recovery is just about starting. So I would say that now would be a good time to buy before we see a lot of price growth come through. It's also quite a good time before lots of international buyers come back. You're sort of beating the rush. If you are mortgaging in the UK as well, mortgage rates are incredibly competitive at the moment. You can get rates, that are less than 1% for a fixed term of 5 years. In terms of a micro market, I would probably look to a slightly undervalued area in central London, so somewhere like Fitzrovia, which has much more capacity for growth going forward. I would also say that I think flats are probably a better option at the moment for investment rather than houses, just because houses have seen a lot of growth over the last year because of those sort of behavioural shifts, whereas flats are probably quite undervalued. And actually, as we sort of return to normal life and we see offices, fill up again and tourists come back, I think we will see a lot more demand for flats coming back in the future.
Yes, I don't disagree with you at all. And I think that, historically, the prime central London market, helped by international buyers, has been the driver out of a downturn.
Yeah.
And I think, as you mentioned in the research piece, it's a role reversal where the central London market is playing second fiddle to the regional markets. So, they will follow for sure. And I think the flat market remains the biggest opportunity. Whether it's Fitzrovia or White City or Shepherd's Bush or Fulham or wherever remains to be seen. I think your point about coming off a low base is good though. And I might just ask Jen, if I may. We've had a question in about the resale inventory that sells to a discount to comparable new build in the same location. And do you have a view whether buying resale or new build is better for an international investor?
So I guess off the back of sort of what you've both just said, that there obviously has been enormous growth, in the resale market already that we've seen over the last 12 months. But there is often a premium attached with buying a new build property, but this is often due to so many different factors which make it feasible. So I guess the provision of residence amenities, landscaping, security, as well as being brand new. So no one's ever lived in these apartments before. Added to that mix, I guess it's a fact that it's in the UK, there's the 10-year build warranty. So there's, with brand new appliances come manufacturer's warranties. So there's a period of time that you're guaranteed this warranty, which I guess is reassuring, if you're an international investor and you want peace of mind. So this premium is feasible. It gives you typically close proximity to key transport hubs. I think that's new build over resale, as well as, energy efficient buildings and environmentally aware buildings that now, all of the developers need to comply to this. So I think that's very important for you to think about as an international investor, whether you're investing for, capital reasons or for owner occupier. And I guess it goes without saying as well with new build, the payment structure often helps with sort of ensuring you get that money out to the UK. So yes, there is a premium, but it's obviously shown with the enormous demand that's been taken up in the UK for new build properties.
Yeah, and I think you're right. If you're an investor, then I think there is an attraction to a tenant into new build because of the amenities they enjoy and the security. A lot of our tenants are coming from overseas. They may be working for corporates or they may be students. And they like the fact there's a concierge that can help them with the best places to visit and to eat and to drink or whatever they like to do. And the security is obviously important for families, making sure their kids are being looked after safely. And I think that is justified. And I think your point about the maintenance is very good as well. And another question, I think, Jen, that I hope you can help with. Are there any benefits buying a property in the UK via a company, or is it better to hold a personal asset?
So I guess the way a property is purchased is very much dependent on an individual basis, and on the buyer's current, financial situation, and circumstances need to be really considered and discussed with your solicitors. And they will determine like whether it's best for you to purchase in your personal name or the company name. However, there is a lower tax rate on a rental income received for apartments held as a company asset. But then again, depending on your, personal circumstances, there can be other factors or tax implications. So it's always best to take your solicitor's advice.
Yeah.
Both here in the UK and, Dhruva and Shweta and the team in India, we work really closely with some very, very reputable solicitors. So definitely after this webinar, get in touch, because we'll be able to send you across some really reputable solicitors. So look, there are some benefits about buying in a company, but it has to definitely be considered everything of your current circumstances.
Yeah, I think the main point there, Jen, is that we can help you with your property requirements, and Gabby can try and forecast in her crystal ball for the future. But any tax, any financial advice, please go to the experts. And as you say, Dhruva can definitely point you in the right direction when speaking to them locally. I think there's a question that maybe I'll pick up. It's about looking to an investment property. Is it better buying a higher yielding asset or buying an asset with capital appreciation? And I think, to be honest with you, we would always suggest the capital appreciation. And I think that whilst the market has not performed since I think, Gabby, back end of 2014-15, there is this proper prospect now of great capital growth. And I think the high yielding assets require much more local focus management, and there are some properties out there, but you need to be on top of them, and they'll require intensive management. They'll probably be secondhand, and so I think if investing from 3,000 miles, my suggestion is going back to that point about the warranties and the guarantees, making sure you've got the right sort of tenants in the right tenancy with all the legal requirements that allow you to manage those tenants, their entry and their exit. I think probably a capital appreciation, and that would be the more modern stock rather than the older second-hand stock. So I hope that helps everybody. Another question: why should I buy in London now? I think, Gabby, you've covered that. Do you think that here we go. Does the panel think what's likely to happen to prices over the next few months? I think, Gabby, you covered that. I think we're saying, don't sit on the fence because you might miss the opportunity. I think there's really strong reasons, as Gabby's pointed out, that London looks like a really attractive buy at the moment, and coming off a low base, and following its regional UK market, so it'll be hot on the hills. So I think London's got a really exciting future. Gabby, what type of investments are more in demand from international buyers? Are we going back to new build again?
Yeah, so for the new build market, we definitely see sort of more of a focus on flats, particularly sort of for Asian investors. They like high quality flats near transport locations. I'd say sort of people from North Africa and the Middle East, they like the amenities that are on offer. So your concierge, your swimming pool, sort of again the very high quality that you get in the new build market. In the second-hand market, we tend to see more buyers from Western Europe rather than sort of Asia and the Middle East. And they tend to look, they're drawn by sort of that traditional architecture. They're looking at sort of, houses and then sort of lateral apartments in sort of mansion blocks and that sort of thing.
Okay, so I think just given the time, maybe one or two more questions. Maybe I'll ask Dhruva and Savills if they've got any, residential developments that they're favourites at the moment.
Well, I'll take that up. We actually tend to like Southwest developments quite a bit, given that, there's great connectivity into prime central London, but the prices are comparatively much cheaper. So I personally like 9 Elms, Vauxhall, all of the Battersea
Yes.
area. That area, and I think what Gabby also pointed out just in one of the slides, is performed really well also. And that's
Yeah.
what we're telling clients, that this is an area to look at, for capital appreciation. So, the story is being told correctly.
Okay, and so the Knightsbridge for you, I think.
Yeah, Dhruv, I think, while we've sort of spoken about the market in general, but it's going to be interesting to understand what is it that Indians look out for,
Right.
specifically, bearing in mind, we are aware of the prices in London as compared to the prices in India. So what has been your experience while interacting with clients in terms of their choices? So what size, for example, because we understand that the apartment sizes are much smaller as compared to what one could get by in India. So what has been your experience here? And also, the next part of my question is, what services do we offer? I mean, as a part of our international desk in India, what services do we offer to an Indian buyer? I mean, to an Indian looking at buying properties overseas?
Sure. So, in that sense of what people are liking or asking for in London, in that sense, I'll tell you, Indian clients are really diverse. So we have pretty much both sides of the spectrum. On one side, we have the end user market, which is clearly looking to self-occupy. These are the guys who have the budgets exceeding that 1 million British pound threshold. In my view, these self-use requirements are in a sense more planned out, and the remittances have happened, in a more planned out fashion. So people have been remitting money over the years. What we have seen, and I'm coming to the other side of the spectrum, is that in recent times there has been, an upswing of investors, Indian investors who are looking to, just invest in properties, and they're, if I'm speaking a bit loosely, chasing yields. So they're looking, and these are the individuals who are looking to invest between that 500,000 to 1 million budget. And what has been a good success, as well as people's ask, because they understand London market in that sense, is the commuter belt, which has been really hot in that sense, because it offers people the rental yield and that assurance of a tenancy in itself. So that is on the demand that we've been receiving. Our services, what we essentially do is, if a client, and they're probably listening to us right now, they reach out to us, we will collate options for you. We'll go as far as getting all the site visits, the virtual viewings done, and our suggestions are based on a lot of research, which is backing us. So any kind of research that is required, and many times the client asks for these inputs from us, so we can handle those really well. Afterwards, like Jen has put it very nicely, we will handhold them in the entire negotiation process, and also assist them, because for an international buyer, many times Indians often ask, how is it possible to purchase something in London without even going there? So, all of that, we'll do all of that hand-holding, from the negotiation to the legal documentation, and even beyond the transaction. So even after the transaction has culminated, from getting the property services done to whether they want to let out the property. So, I mean, we cover the entire ambit of services which, any property owner requires in the international market.
It's probably worth just adding in there quickly, Dhruva, you've just mentioned lettings, which we work so closely here with our lettings team, and often we can gain early access to the developments. So we'll actually be looking for tenants, for your investment, before you've even completed. So there's often a very short period where, you know, your apartment would remain empty. So I think that's definitely something to think about, that Savills definitely offers that turnkey letting solution, that we, you know, manage it from the moment you contact Druva and Shweta through to making sure, if it's for an investment purpose, that, you know, we get that tenanted out very quickly.
Yes, absolutely.
Shweta, any more questions from your end? Otherwise, I think we might wrap up, given that we've taken a lot of time up for people.
No, I think we are quite good, and it was a very, very insightful session.
Okay,
And,
brilliant.
yeah.
Well, I mean, I would just like to say thank you very much for listening. Thank you to the panel, of course. Just to say that we will, of course, look after your clients, Shweta, Druva, as well as you would expect us to, and we have, you know, a fantastic portfolio. Jen's run through a small selection, but we have a fantastic portfolio that you may be all interested in. And thank you very much for taking the time to listen to us. Please do stay very safe. If you've got any more questions, then please do get in touch. Otherwise, good afternoon and have a good rest of the day. Thank you very much.